Welcome to the Big Three, where we are going to go over 3 stocks, 3 charts, and 3 trades. I'm going to be your host, Kevin Green, and we're going to start off with Cheniere Energy. This is a company that has seen its stock skyrocket over the year here because of the expansion of liquefied natural gas and the demand that we have seen pretty much across the globe. Now, we have seen the stock kind of pull back here if you're kind of looking at the technicals after hitting $228.81 around a month ago here. Now we are seeing a little bit of an area of support, which is sitting at around $210, which is trading at right now. And we are maybe going to see a dead cat bounce or potentially maybe a reset and a move to the downside here. So from a technical standpoint, we could see at the start of the year, we had this consolidation pattern or this basing pattern, leveraging that 200-day moving average as an area of resistance. Then in around June of this year, we did see a nice little pop to the upside as demand for liquefied natural gas started to increase around the globe. And we started seeing the stock actually rise to the upside here, had this expanding megaphone pattern. And then we saw another breakout, which we saw a vertical move to the upside, where the stock may have gotten a little bit ahead of itself. We do see on the volume profile, it has been thin when it comes to the amount of shares traded at these particular levels. And now the stock has seen a little bit of a pullback. Now, the first area of support is going to be around this $210 to $200 range. That would actually be the upper end of that channel line. And any further breakdown below, you could actually see the 200-day moving average once again, which was an area of resistance in the past, now become an area of support sitting at around $180.14. We also have the RSI, which has seen a little bit of a bearish divergence that has now been corrected, where it has made lower highs as well as lower lows and getting pretty close to that oversold territory. And the MACD, which we already did see across with that 12 EMA below the 26 EMA, has now gone up below that zero line, which does confirm the bearish trend. But we are seeing that 12-period moving average, exponential moving average, actually hinging up a little bit. So maybe we do see a little bit of a bounce. Now, once again, this has been a theme or a secular trend within the market is when it comes to the expansion of liquefied natural gas. With the new Trump administration, we may see an easing when it comes to regulatory policies, which could actually be a tailwind for the stock. Now, we know that the inauguration is going to be on January 20th. And the market is actually expecting a fair amount of announcements and executive orders to be introduced, especially when you're looking at the energy sector. Now, if you are optimistic on this name, you could actually look at the example trade here, where you are looking at a call spread, the 210-230 call spread expiring February 21st of 2025 here, looking at doing this at a debit of $6.30. Which the max loss would be the debit paid, $630, max profit, which would be the difference of the spread minus the debit paid, which would be $1,370, with a break-even point of $216.30. This trade would max out if the stock is above $230 at the time of expiration. And if a market is available, you could actually remove the trade if it is in your favor, or if the stock is not going in your favor. Now, this is a risk-defined strategy in order to try to capture the upside potential or maybe a bounce off of some of these near-term support areas, but also maximizes or minimizes the risk to the downside if we do see a further breakdown in the shares. The next stock that we are going to look at here is going to be Iron Mountain. Now, Iron Mountain has been known for a lot of traders and investors, or just regular individuals that go into the office, as the individuals or the company that actually goes and shreds documents. But we have seen a nice little rise to the upside for this year as well, because they also have a data center arm, and they have been able to expand their data center presence and the infrastructure and actually sell or lease those data centers out to small and mid-sized companies, which is why we have seen a coinciding move to the upside as of late when it comes to this name. Now, once again, just like we saw with Cheniere, we have seen an actual fundamental breakdown when it comes to the shares. After touching $130.24, back at the end of October, we have seen a pullback getting very close to that 200-period moving average, which is sitting at around $100.64. Now, one thing to note when it comes to this stock, you can actually see the expanding megaphone pattern that's pointing towards the downside. That means that there could be, once again, a downside move, but also greater volatility in the shares. And that's exactly what we have seen. Now, Iron Mountain is actually a REIT, so it is interest rate sensitive. So it's not uncommon to see interest rate sensitive products actually selling off as the 10-year treasury or even the 30-year treasury has moved to the upside. Now, from a technical standpoint, if we did see a further breakdown below that 200-period moving average, we do have this gap in this ledge here on the volume profile between $86 and $90, where the stock could actually be attracted to and maybe see an area of support coming in and buyers actually stepping in because of that volume profile. Kind of shows that there was a fair amount of changing of hands when it comes to the shares around that level. Now, the RSI has been very interesting. It's been in a bearish divergence pretty much since the start of July. And now that divergence has been corrected for the most part, and we are seeing oversold territories when you're looking at that RSI, and it's trying to bounce and hinge above the oversold level of 30. Now, the MACD has crossed the 12 EMA below the 26 EMA, and it has not bottomed yet, but you can see that 12 EMA actually trying to hinge a little bit higher. That would be your first signal if we do see a positive cross with the 12 EMA below the 26, that buyers might be stepping in and we may see a near-term bounce. But with this technical setup and the volatility of the shares, it's not uncommon and not surprising to see a little bit of a pullback and a correction. Once again, keep your eye out on those support areas. And if you do believe that a bounce could be on the horizon here, you could look at a very simple call, buying a long call to be able to get upside exposure here. So this example trade is looking at the January 17th, which is the January monthly, 105 calls, and buying this for a debit of $2.70. The max loss on this trade would be the debit paid $270, and the max gain on this trade is actually going to be unlimited because the stock can move to the upside and does not have any type of ceiling when it comes to price. Now, the break-even point would be $107.70, and this stock, once again, or this example, would actually be profitable if at the time of expiration, the stock is above that break-even level of $107.70. Still have around 21 days till expiration for the trade to be profitable here. The next stock or ETF that we are going to look at is actually going to be the XLE. Now, we have seen a significant sell-off when it comes to the XLE over the last couple of weeks here, and rightfully so, when you are seeing maybe an area of resistance that has been hit right around that $95 to $98 level. And now we are seeing a little bit of a pullback and potentially a correction that's actually taking place within the ETF. Now, on a one-year daily time frame, we have seen the ETF actually being fairly choppy. Earlier on this year, catching a little bit of a bid as crude oil was touching the $80 to $85 level. We saw a lot of enthusiasm when it came to the oil stocks. But once again, hitting that area of resistance at around $95 to $98. And then we saw this channel pullback that took place. It hit the 200 period moving average, tried to bounce higher, and then we did see it fail. But one thing about the ETF is it does appear that it is mean reverting, meaning it's reverting back to that 200 period moving average. And maybe we are seeing some oversold technical levels right now, which is sitting at around $82 to $83. Now, on this chart, I also have this purple line, which is a 3-2-1 crack spread, which really measures the profitability of energy companies when they try to refine oil products into finished products, which is gasoline and diesel. And we can see that there was a massive divergence towards the end of the year, pretty much between September and November, where that crack spread or the profitability was actually pretty much stabilized, but we actually saw the equity valuations continuing to move to the upside. So now we have seen the market correct that here for a little bit. RSI is actually also in the oversold territory, trying to bounce higher, trying to get above that 30 level on the RSI, and does show that maybe an oversold condition has taken place. And then we also have the MACD, which the 12 EMA is below the 26 EMA, but the 12 EMA is trying to hinge higher. You'd like to see that cross of the 12 EMA above the 26 to give you the first indication that buyers may be stepping into the market. Some areas of resistance is going to be that point of control level, which is going to be $90.30. That's where we have seen the heaviest amount of volume being traded over a one-year period. And then the next area of resistance could be the 200 period moving average, which is sitting at around $91.20. Now, if you are bullish and do believe that a rebound could be on the horizon here for XLE or some of these energy stocks like Chevron and Exxon, which is a massive component of this ETF, you could look at trying a call spread. So for this example trade, looking at an 85-88 call spread for January 10th. Buying the 85, selling the 88, doing this for a debit of $1. So the max loss for the trade is going to be the debit paid, $100. The max profit would be the difference between the spread minus the debit paid, which is $200. So you're looking at a 2-to-1 risk-reward ratio for this trade. Now you have a little bit of time, and you could maybe see, once again, the enthusiasm because of the new Trump administration, maybe some buyers stepping in, or maybe because of the oversold nature that we have seen for stocks over the last couple of weeks, some buyers trying to rotate into some underloved sectors. So this is, once again, risk defined, gives you some upside potential. If there's the market available, you could take off the trade beforehand if you do believe that it's going in your direction or if it's going against you. And with that, that's going to be your big three for today. Thank you for tuning in. We'll see you on the next one.